The investor index declined in the third quarter to 81.9 from an upwardly revised 99.4 in the second quarter, the unfolding debt crisis in Europe and the risk aversion to emerging market assets are the scapegoats for the deterioration in foreign investor confidence. George Glynos, the MD of ETM, is going to walk us through the latest investor confidence index. Of course, that's the Maxim ETM investor confidence index. George, it's dropped, and the big drop is as a result of foreign investor confidence really dropping off.
Yeah, I don't know that it comes as that much of a surprise, really, given what's unfolding in Europe. Talk that Europe's going into recession, all the debt concerns throughout the developed world. So all of that fueling a tremendous amount of concern abroad. That concern, I think, has been reflected in terms of the view towards risk assets in general, and of course emerging markets fall into that category. So from the volatility perspective of this index, it makes sense that the volatility went up, and of course that counts against investor confidence in general. But interestingly enough, when we looked at the components, the subcomponents that make up this index domestically, we saw very strong rotation back towards bonds, which typically is a defensive statement by those investors that are looking at the three main asset classes. And I think that speaks volumes about exactly where investors feel that there's value to be found.
Especially with yields on the bond market sitting where they are at this point in time, and the returns on the equity market very uncertain at this point in time as we go into 2012 with downward revisions to GDP growth, and that of course won't bode well for future earnings of companies.
Exactly right. So what this index also captures is a leading indicators component, which tells us that growth is unlikely to be particularly strong through 2012. Maybe we get a little bit of an uptick now in quarter four, but unlikely to be sustained in the broader context when you've got Europe heading for recession. At the same time, we know full well.
So Europe, in your view, is going to be heading into a recession. Of course, it's very uncertain at this point in time, but what is the House view at this point?
Yeah, the House view is certainly for Europe to be going into recession. I mean, they're in the midst of a credit crunch as we speak right now, which is why the central banks all clubbed together just yesterday to announce that they were going to provide liquidity. But it goes a lot further than that. Liquidity is only part of the problem. Solvency of governments is another one, and that's not going to be resolved just through some injection of liquidity into the banking system. So they've got some tremendous headwinds that they've got to fight through. I suspect that that's going to be a long haul. We're talking about 5 to 10 years, almost a generational thing here that has to unfold in terms of structural changes. And that is likely to translate into a lot of uncertainty, a lot of volatility, not the kind of environment where you see equity markets per se performing particularly well, unless, and here's the big caveat, is unless we start to see central banks becoming a lot more forceful in the way that the Fed was forceful with quantitative easing versions 1 and 2 in the Bank of England.
More aggressive expansionary policy would be supportive to equity markets.
If it were to come, now we know that the ECB has been incredibly reluctant to go that route.
But isn't that just exacerbating the problem? I mean, that's where half the problem came as a result, just creating more debt.
In the short term, it certainly exacerbates the problem. So this whole uncertainty as to whether the ECB is going to step in, what they're going to do, maybe it's the IMF, we don't really know. What we do know from a market perspective, if you want to calm down the market fears that are clearly reflected in this investor confidence index, is that you would want the ECB to step in a way that the Fed has done, in the way that the Bank of England has done. But there's a huge reluctance to do so whilst there isn't much of a fiscal coordination between all those countries in Europe. So here we go. It's an unfortunate environment where it's reflected in an investor confidence which has dropped quite sharply, and suggests that equity markets are still going to have a tough time, at least until such time as the central banks step in.
Yeah. Another issue that plagues South African businesses, especially those that are importers and exporters, is of course the rand. Now, whenever we ask for forecasts on the rand, there's always the caveat from analysts saying that it's impossible to predict the rand. There begs the question: are we looking at the right monetary policy by targeting inflation? Should we perhaps put on the table looking at exchange rate targeting like we have for, say, in Nigeria?
So here's the thing. Nigeria, for example, has a tremendous current account surplus. So they export oil, they've got a lot of inflow. We don't run a trade surplus.
So we don't
as
have
such.
basically the firepower.
We don't have the firepower. Our reserves are quite small. We're not generating the kind of trade surplus which would give us the firepower to be able to defend our currency. So I think FX intervention, which would be required to peg a currency, would be a tall order for South Africa. I don't think we have it, not now, and I certainly don't believe we'll have it in the future.
It has been supportive to, you know, the likes of China, though. But of course, you know, huge exporters there, and also the firepower that they have. It's
been supportive to a degree, but there are costs involved to that, and that cost, as we've seen recently with regards to China, can translate into inflation if, for example, the peg that you pegged against, in other words the dollar, is losing a tremendous amount of ground. It effectively means that your own currency is losing quite a lot of ground, and we saw an inflation episode result specifically because of that. So it's not to say that that is the be-all and end-all, the silver bullet to cure South Africa's ills. I think what South Africa needs to focus on is the root cause, and the root cause is that we're not productive enough and we're not efficient enough. And it's a combination of those two rather than focusing on currency or inflation targeting as a policy, which I think is going to yield a better result.